There is this really persistent myth out there in the business world. People think that to scale a real, successful venture, you literally have to start with a mountain of traditional bank debt from day one. But what if I told you that's just not true? The data actually paints a completely different picture. Some of the smartest entrepreneurs out there use highly strategic funding methods right out of the gate to bypass institutional debt altogether. And why do they do it? Because these alternative pathways often reduce both personal and professional risk, while absolutely turbocharging early growth in ways a standard run-of-the-mill loan simply can't match.
Welcome to this explainer. I am absolutely thrilled you're here with us. Today, we're diving into capital growth, strategic funding methods for entrepreneurs. We are going to break down the most effective ways to finance a business, cut through all the noise, and look at the actual strategic advantages and, the hidden traps of each method. But most importantly, we're going to give you a solid framework to figure out the exact right funding source for your unique situation.
So here is our roadmap for today. We'll be climbing an escalating ladder of scale. We'll start with self-funding your business, then borrowing from inner circles, looking at traditional bank loans, bringing in outside investors, exploring the power of crowdfunding, and finally, choosing your specific growth path.
All right, let's jump straight into Section 1, self-funding your business. This is, hands down, the safest possible start for a new venture.
Now, self-funding, or bootstrapping, as it's often called, is a massive trade-off. By using your own personal savings, you get complete control and zero debt. You answer to absolutely no one. But the flip side, slower growth and limited resources. Your growth is essentially handcuffed to whatever happens to be sitting in your checking account right now. So you're basically trading rapid scaling for total complete security.
Moving on to Section 2, borrowing from inner circles, which means looking to your family and friends.
If you find yourself needing a little more runway, your inner circle can provide an incredible lifeline of quick capital. It's great because it relies on existing trust, completely bypassing all that corporate red tape. But, and this is a huge but, it comes with a massive warning label. It requires crystal clear, written agreements to avoid conflict. Mixing personal ties with an early-stage business is notoriously risky. So you absolutely need clear terms from day one to prevent any messy interpersonal drama down the road. Okay, scaling up further, we hit Section 3, traditional bank loans. This is where we leave personal risk behind and enter the world of institutional funding.
So, unlike a flexible favor from your uncle, institutional money is rigid. It means mandatory repayment with interest, period. But the strategic advantage here is the sheer scale of it all. This is exactly how you secure massive, non-dilutive capital for things like heavy equipment, bulk inventory, or commercial real estate without giving up a single drop of equity in your company.
But before a bank actually opens the vault, lenders are going to ruthlessly evaluate two main things. First, your repayment capacity, which just means your actual, verifiable ability to consistently pay back the loan month after month. And second, your financial history. They want to see a rock-solid track record with credit and finances. If those two boxes aren't decisively checked, well, that capital stays locked up tight.
But what if your business model doesn't generate that immediate cash flow yet? What if you need significant capital to scale but want to completely avoid traditional bank debt? That brings us to Section 4, bringing in outside investors. Enter angel investors and venture capitalists. Basically, these are individuals or firms that provide funding to your business in exchange for a percentage of ownership. They hand over substantial capital without slapping you at heavy monthly debt payments, but they do take a piece of your company in return. They're making a calculated bet on your future valuation, not your current cash flow. This right here is the ultimate dynamic trade-off in the startup world. Yes, you are giving up ownership and equity, you're slicing up your pie and sacrificing pure autonomy. You're not the sole decision maker anymore. But look at what you gain. Aside from the funding, you're buying into incredibly valuable business experience and deep industry connections. When investors own a piece of your company, they are heavily incentivized to see you win. So almost overnight, their powerful network essentially becomes your network.
Now for our final specific funding method, Section 5, the power of crowdfunding, which is all about looking to the public to validate the market.
You see, the real magic of crowdfunding isn't just getting the money, it's actually a brilliant dual-purpose tool. It simultaneously gives you funding, plus market demand validation in real time. By launching a campaign, you are literally testing whether real people actually want to buy your product. If the crowd opens their wallets, you know for a fact you have a highly viable product before you ever fully commit to manufacturing and distribution. It's a real game changer.
Which finally brings us to Section 6, choosing your growth path. A final synthesis of everything we've talked about today.
So how do you actually pick the right path? Well, it takes a pretty harsh audit using these 3 essential steps. Step 1, evaluate your business stage. Are you just a sketch on a napkin, or are you already generating predictable revenue? Step 2, define your growth goals. Are you trying to build a quiet, sustainable lifestyle business, or are you out to scale a massive global empire? And Step 3, assess your risk tolerance. How do you actually feel about taking on institutional debt versus losing total control through equity dilution?
It all really boils down to this fantastic takeaway from our research. There is no perfect financing method. Choose the one that supports sustainable growth. The absolute best choice isn't just the one that gets you the biggest check. No, it's simply the one that aligns with your specific, personal goals and keeps your business safely moving forward.
So I'll leave you with this final provocative thought to chew on. Based on your specific business stage, your goals, and your risk tolerance, which financing method will fund your future? Thank you so much for joining me for this explainer. If you found this strategic breakdown helpful in figuring out how to fuel your own business, please take a quick second to like, subscribe, and share this explainer with other entrepreneurs who are out there looking to grow. Until next time, keep building.